Great. So welcome you all once again to today's section. Today we are going to continue with the consolidation. Okay. Great. Today we are going to finish up with the intra-group adjustment with the remaining two items that we listed from the previous lecture. So today we will look at intra-group dividend. Intra-group dividend. Now the item we are going to look at it today. Intra-group dividend. I like that. Intra-group dividend. Everything about intra-group dividend. Good. Intra-group dividend. Here we are interested in dividend paid by the subsidiary, not the parent. Parent dividend, you know the treatment. Is a dividend paid by the subsidiary. That's what we are interested in. Good. So this is dividend paid by or declared by subsidiary. So dividend paid or declared by who? The sub. That's what we are interested in. Dividend declared by the sub. First, we look at the post-acquisition period and pre-acquisition period. There are two ways. The subsidiary will declare or will pay dividend in the post-acquisition period. So post-acquisition period, and two, pre-acquisition period. Pre-acquisition. We call it pre-acquisition dividend. How do you treat it? It's a bit technical, little, too little, not too huge. Okay, so let's start with the post-acquisition dividend paid by subsidiary. Now, the idea is the post-acquisition dividend paid by the subsidiary, the parent should not account for it as what? Other income. The normal treatment is that when the subsidiary pays the money, parents record it as what? Other income, right? In the books, which is totally wrong in the consolidation because you can't pay yourself. You can't earn money from your own self because parent and subsidiary, they are single economic entity. Good. So we have to reverse it. That's all. We have to do what? Reverse it. In the reversing process, look what they're going to do. I'll come to the pre-acquisition dividend. It's an post-acquisition dividend paid by the subsidiary. There are two questions or two critical ways that we will bring the question. Here, parent has recorded it or accounted for. So let's say accounted for. Yes, parent has recorded this dividend in his books. Not recorded or not accounted for. Not accounted. These are the two ways. Yes, the subsidiary will give you the money all right, but it has not been recorded. That's good news. Subsidiary will give you the money all right. I've recorded it. I've taken the records of it. That's the two ways. So your exam question, look at it critically and know which of these, because only these two versions you're going to see. Great. Now, all what you need to know is in console P and what happened there. In console balance sheet, what happened there? You are done. So the question that you are solving, if it's a console balance sheet and then it has been accounted for, what do you do? If it's console P and what do you do? That's all. So I'll put P and L here. I'll put console P and L here. So when I put P and L here, it means that console P and L. If the parent has been accounted for, reverse it. So what do? Accounting treatment, subtract. Yes. The profit or loss. Parent has added it to the other income. So you go to other income and subtract it. So go to other income and do what? Subtract it. Why are you subtracting it? Because it's an intra-group adjustment. Intra-group adjustment. We're eliminating all the intra-group adjustments from the box. That is all. Now, what happened to the financial position? The balance sheet. So financial position is here. In the financial position, if you are doing console financial position, parent has accounted for it. What do? Now you do nothing. Do what? Do nothing. Don't touch it. Yes, if the parent has recorded, do nothing. Don't touch it. Do nothing because parent has recorded it. The cash has been recorded in the parent's book because when the subsidiary pay, let's say 30,000 to the parent, being the proportion of the percentage holding, the subsidiary will subtract this money from his cash and subtract from the profit, right? So that it's hanging in the air. If the parent has accounted for it in a financial position, it's the same. So that one ends there. But for the P&L, no. So for the P&L, we take it off. Good. From the P&L. But for a financial position, once it has been accounted for, it's okay. You do nothing. If you reverse it, it will hang in the air. Now let's go to not accounted for. Then we are done. That's all. What if parents have received the money, but no records, no accounting treatment? Good. So what do? If there's no accounting treatment, in the P&L, what do? P&L, what do? In a financial position, too, what do? That's all. You are done. Because the console that you are going to meet is P&L and financial position. We are done. Or both. Yes. We give you the two. Okay. May 2017. Great. So, if parents have not accounted for it, and the P&L, what do? Do nothing because we don't need it in the P&L. So do nothing. Do what? Nothing. Because in the P&L, we don't want to see the dividend in the P&L. So if the parents have not recorded it, that's the good news. So do what? Nothing. In a financial position, what do? You record it. You record it. You record it. Good. Now, the issue is this. Technically, when the subsidiary pay the money, the subsidiary has what? Subtracted it from where? It's cash, and then subtracted from where? Is what? The profit. So now the money is hanging in the air. The parents have not recorded it. So if parents have not recorded, the money will vanish. So one of them must take record of it, right? So that is it.
This one is subtracting, this one is adding to it to cancel.
Exactly. So now the issue is this. The money is hanging, the check is hanging. So now record it. A, add it to the parent's cash. B, add it to the group retained earnings, and then we are done. Good. So that's the main reason why we are recording it. Because we don't record it, it has vanished in the air. Because the subsidiary have taken it off from his books. But when he pay, so you have to bring it back, right? Because it's still within the group. So here, add it to the cash. Add to cash, that's the first entry. Second entry, add it to the parent profit, that's the group retained earnings. That's all. Add it back. Add it to the group retained earnings. So this is it.
So you said this one is parent. So what are the subsidiaries has recorded it to you?
This is
Give subsidiary report.
this is
And
where
give subsidiary report.
this is where the subsidiary will pay dividend, but the parent have not recorded it in his books, but have received the money. How we get it? Uh-huh. That is, please watch this carefully. You are going to meet one in the exam. Watch it carefully, and definitely you will get it that P&L or financial position. So the treatment is very important. Good. So that is it, and then it ends here. This is what we mean by post-acquisition dividend. Dividend paid after what? Acquisition. Post. Then we have for dividend paid from pre-acquisition profit. Pre-acquisition profit. So that is it. I'll explain that one, then we are done. If you don't have any question on this, then let me know before we close the chapter of the game. If you go to the past question, these are the section that you will see. So basically, that is it. Subsidiary pays the money. It will be up from the subsidiary's book, and then the money is hanging. So if the parent
And your subsidiary
does not
report.
record it, the money will still be hanging. Meanwhile, the money is for the group, so it must come back to the group. Good. Wait. If the subsidiary have paid a dividend, but he himself have not recorded it, that is normal treatment, normal dividend recording. So record it in the subsidiary's books. How do you do that? If you pay dividend, subtract from the subsidiary retained earnings as report. Then what do you do? Subtract from the cash. That's all. So use cash to pay. Then we are done. Now let's move on to the last aspect of dividend.
So that's all. If you subtract from the subsidiary profit, that's all.
That's all.
You don't wait there.
Two treatments. Subtract from subsidiary profit,
Then add
and then
to-
they subtract from where? Subsidiary's cash balance. You're going to use cash to pay the dividend.
you don't tax retain.
Don't touch it. Great. Now the issue is I'll add a declared. What if here declared, meaning that it has not been paid. So where you see the cash, it must be added to the receivable. Receivable. Agreed. It will be added to the receivable. It means that the subsidiary have declared the dividend, the money have not been paid yet. So that's the receivable. Then you add that. Okay. So basically that is it. Please, there are some remix of this. But if you get this one from when I'm solving the question, you'll be fine. Good. Now let's move on with the last section of dividend. We have what you call dividend paid from pre-acquisition dividend. So pre-acquisition profits. So we end up calling pre-acquisition dividend. So that's where we are now. Pre-acquisition dividend. Pre-acquisition dividend. So anytime you are solving the concept, kindly bring these issues out, and then you'll be fine. So that's the number 2 that we are doing. Dividend paid out from where? Pre-acquisition debit profits. Dividend paid out of what? Pre-acquisition profit. Pre-acquisition profits. How do we get it? Now let me give an example. What we did first is what? Post-acquisition profits, right? Dividend paid after acquisition or after profit in the post-acquisition period. That's all. Now let's assume that this is the year. This is 31st March 2018, and that's where you acquired what? Parent acquired a subsidiary. Acquisition took place here. This is January, and this is December, the reporting period. December. The subsidiary has been successful. It paid dividend consistent throughout the year to the extent that it paid total of 36,000 Ghana cedis as dividend for the entire year. For the entire year. So from where? January to what? December. Now he paid this money at the end of the reporting period, but from the whole year's profits. That is it. So it suggests that there are some 3 months or between this period, you are not there. So money that he has gathered so far, as soon as he joined you, he has given it to you. How do you get it? Now let me bring this one into real life. Now when probably couples want to get married, at least in a normal show, is the man have to go and buy everything, right? By this time around, the ladies have prepared everything for you. Come and see the parents and let's go. That's all. The lady rather will pay. Exactly. That is it. So that's why we call it what? Dividend paid out for pre-acquisition profit. What the lady has suffered years back, the guy have come and then take the money, used to pay what? To the father. So it's like robbing Peter to pay Paul, right? Exactly. So that is it. So let's bring it here. How do you know that this dividend was paid from profit made before the acquisition? How do you know? They're saying that they paid 36,000, and this 36,000 it was deemed throughout the year. It was paid out of profit made throughout the year. And each month, you can get each month home. So divide this one by 12. Each month will be what? 3,000, right? So every month, 3,000. So they pay 3,000 each month, coming from each month profit. But you acquire the person on what? 31st March 2018. So that means he has that dividend. The money is given to you coming from previous profits. Because you acquire the guy and I start giving you money. Where do you get the money from? It's no work. Today now I'm coming to see you say, oh, I should take something for TNT. I take something. No. So our deem as what? Pre-acquisition dividend. Sometimes some people do that so that to catch the interest early and secure everything so that yes, the guy will not run away. Have you seen? Uh-huh. So the same thing happened to parent and subsidiary. That is it. Now the question is, how do you treat it? It is not all. It's the dividend that they pay out of profit made before the acquisition. So 3 month profits. So 3 month dividend, which is what? 3,000 times your 3. So 9,000, right? So this 9,000 becomes what? Pre-acquisition dividend. In short, even though the full name is what? Dividend paid out of what? Pre-acquisition profits. The guy has suffered, get the money. As soon as you acquire the guy, he's not giving you some of the money. You are not there while the guy was making that money. That's our point though. Have you seen? You're supposed to give the guy money or the lady money. Lady has suffered his money somewhere. As soon as you saw the person, go to the bank, withdraw all what she have for you, give it to you, add whatever you have, add it to go and give it to her parents. So this is what you call pre-acquisition what? Dividend. You've not fully acquired the asset, but you are enjoying the benefits upfront. How we get it? Good. Now, first, you should know how to arrive at that. So any dividend paid out of profit made before the acquisition is called pre-acquisition dividend. How do you treat it? Accounting treatment. Yeah, we assume that it's just offsetting. It's an offsetting, but it's just giving you whatever you're going to give it to a dad. It's just giving you some in advance. So you pick that money and give it to you back. So now the issue is this: We just subtract it from where? The cost of what? Control. That's all. So all this long talk, it will reduce how much you're going to pay to the dad because you are going to add your personal money to it plus whatever she gave you. So that it means that indeed, true, the cost of that expenses is what you paid, not what she gave you. How do you get it? So what do? So subtract it from the entire cost. So if you go and the father charge you, let's say 50 million, yeah, and then maybe she give you 20 million. So that means in actual sense you paid what? 30 million. So your cost of control is 30. You didn't pay 50. Because only 30 came from your pocket, 20 came from like as a return back to you. In accounting, we call it return. Return giving back. So that return will be used to offset how much you are paying. So that's all. So accounting treatment subtracted from where? Cost of control. And then if they have not recorded it at all, if parents have not recorded it at all, the treatment will be like this. Because you need two accounting treatment. So one, A, add it to your cash. Yes, enjoy it. Enjoy the money. Add it to your cash. B, subtract it from where? Cost of control. We are done. It has also appeared once. The same year that the head office expense was allocated, the same year it came. So basically, that is it. So this 9,000, add it to your cash. Yes, it's an enjoyment. Add it to the cash.
This one, is it when the parents or the subsidiary hasn't recorded?
This is the where the parent have not recorded it at all. The subsidiary will do the recording. Subsidiary will do the recording because they aren't going to pay the money. So we record it in his books. But the parents will not take note of it. So we have to record it. But if the parent have recorded, it will be this. He will add it to the cash and add it to the dividend and treat it as other income, which is totally wrong. He will treat it as what? Other income. That's what we don't want to see. This is not other income. This is not other income. It must be subtracted from where? The cost of investment. Yes, the cost of investment. So if you go and something like use the real life example, then you are fine. I don't go into detail. Yes. Someone say yes, both side. Okay, so I'm done with the intra-group dividend. Let's go to intra-group loan. And that's all. Then pick a full question and start debating on the question. Intra-group loan. How do you treat intra-group loan? Intra-group loan. Intra what? Group loan. How do you treat intra-group loan? And then that is the end of the intra-group adjustment. For now, the rest they will pop up. Minor ones, they will pop up in a question when you are solving the load. Unfortunately for us, today's question is a bit critical, like a bit lengthy.
Let's take a simple one.
No. Okay.
Okay, but you've given us this thing, all the adjustments, so you want to.
Now let's continue. I hope I can take the screen off. The last intra-group adjustment that I want to do is what you call intra-group loan. Intra-group loan. Please, it's not compulsory by force again. Not compulsory by force for you to see all these intra-group adjustments in one question. Not at all. A selection, divine selection. So select 1, 2, 3, mix them, you are done. Combination or pen them. So you bring this one. But some of them they are Kong. Some of them they are Kong. Unrealized profit, fair value adjustment, those one, and the good those one there, you can't argue with them. But with the something like intra-group dividend or the intra-group loans. Yes, exactly. Good. So intra-group loan, intra-group loan, intra-group loan. Here we are interested in parent giving loan to subsidiary or vice versa. How you get it? Parent giving loan to subsidiary or subsidiary giving loan to us, the parent. So I'll take one position. First, you should not give yourself loan. It's not a loan. You can't give yourself loan. I'm listening. Unless you are distinct from yourself. So like the owner is distinct from what the company. So the company can give the owner what loan. That's drawings or dividend. But if you are one, you are together, you can't owe yourself. That's what they say, you can't kill yourself. Have you seen? You can't kill yourself for this exam, so the same way you can't owe yourself for these exams. You don't be held liable for this exam, so you can't kill yourself. The same thing apply here. So you can't owe yourself, you can't give yourself loan. That's the fact. Good. So it must be reversed. It must be what? Reversed and eliminated immediately. All interest paid to must be eliminated. All this one must be the post-acquisition period, not the pre-acquisition. The intra-group adjustment, we are interested in what? The post-acquisition period, after acquisition. Good. So that is it. Now let's see how you treat it. So first, I'm just assuming that parents are giving loan of 10% loan note. 10% loan note, and the value is what? 40,000, right? After the acquisition. That's all. How do you treat something like this? Treatment number one. Tell me, in parent books and subsidiary books, parents record it as what? Investment. Yes, it's an investment. I'm giving somebody loan at the rate of 10%. Every year, the person will give me what? 10% of the value. So it's an investment to the parent. So parents record it as what? Investment. So come here, non-current asset. Check the non-current asset. In parent books, it will be there as what? Investment in the financial position. We record it here, maybe 40,000. Go to the subsidiary. Subsidiary record it as what? As what? Liabilities. So go to non-current liabilities. Non-current liabilities. It will be there as what? Loan. Which is what? 40,000. No, you can't do that. So all this must be related. So first, subtract it from where? The non-current liability. Second, subtract it from where? The cost of investment. Subtract from where? The investment. Now, sometimes the examiner will show it different from the other investment. Go and relate it. If they don't show it different, then it will be in the cost of investment. Subtract from there. So let's go to the accounting treatment. This is the illustration. Good. So the accounting treatment will look like this. One. Subtract it from where? The loan. Non-current liability. So go to non-current liability and subtract it. B, investment. This investment, either the examiner will add it to the cost of investment. So the cost of investment will be one. It includes what is paid for to acquire and the loan given out. We put all of them together. When we go subtract it, we'll go there and subtract from what? From cost of investment or from the investment. You are done. This is the principal value. Left with the interest. So let's go to the interest. This is the principal loan. The loan itself. And left with the interest. Because if you're receiving interest, how do you get it? If you're receiving interest. And here to treat it as what? The same as the intra-group dividend. How we treat post-acquisition dividend, the same to treat the interest. So we have that. How? You have to eliminate it. Parent will record it in where? The P&L, right? Go there and subtract it from the parent, from the P&L. It will be part of the other income. So you subtract from where? Other income. That's all. We subtract from where? Other income. So that's where the parent has recorded it. The interest must be subtracted from where? The P&L. P&L. Subtract it from where? Subtract from the other income. Other income. Here done. Now, the treatment is the same as the post-acquisition dividend. So the diagram that I do there, the same thing will happen. So this one is just a shortcut that I place it here. Because interest and dividend. So that is okay. Another note, as is the balance sheet, you do nothing. If the parent have recorded, you do nothing. But if the parent have not recorded it, because subsidiary pay the interest, you take it from the books, so that the funds will be hanging. So what do? You don't have to record it if the parent have not recorded it. So basically, they say go. Now that is the end of the intra book adjustment. Now I'm going to do the real console. Great. In the P&L, you subtract from the other income from that of the parents, and again, the finance cost of the subsidiary. The subsidiary will do what? Will subtract from where? Its finance cost. Right? What do you do? So we take it off. Subsidiary will add it to the finance cost, right? You have to subtract. That's all. So the same figure will be subtracted from other income. That's one. Two, the finance cost of what? The parent. The finance cost of the subsidiary. So finance cost here must be the parent. And then the finance cost of who? The staff. All of them are going to the one group account. So the same as you picking it from staff. You that's will be a mini subtract, not subsidiary. Good. You are subtracting from where? The other income. At the same time, subtracting from where? The finance cost. That's all. So subtract from other income and then the finance cost. Why? Because in the P&L, to the subsidiary that was the subsidiary that paid the finance cost. That's why we added to the net asset. That's why we added back towards the net asset. Yeah. These are the two entries. These are the two entries. We are subtracting from where? The other income, that's the debit. And then finance, we are subtracting from finance cost, that's the credit. So then we are done. It must balance at the end of the day. Okay. So this is the intra-group loan. Good. Then that is it. Now just that if you have the financial position, if you don't have a financial position, what you have to do is this. Assume there's no P&L. Let me do it here. So that's assume that you don't have. This is the P&L section, right? Let's go to the financial position. In the financial position, we subtracted from where? Other income, right? Other income of who? The parent. Parent profit, where is it? In the financial position. Group what? Retained earnings. So number one, we subtract from there. So subtract from where? Group retained what? Earnings. Agreed. Then two, we subtract from finance cost of who? The subsidiary, right? And then in the financial position, what subsidiary profit? Net asset. He has subtracted the finance cost from his what? His profit, right? So what do? We add back. We are reversing it. So I'm going to do what? Add back. So now what do? We add it to what? The net asset of the subsidiary. How we get it? That is it. In the financial position. So this is the financial position treatment. P&L. We are done. Agreed. Because in the financial position, the subsidiary, when the subsidiary pay the interest, he will subtract it from his profits through the finance cost. Good. So in the financial position, the subsidiary net asset has gone down by that figure, which according to the group account, it's supposed to be like that because you cannot owe yourself or can't pay yourself interest. You can't earn from yourself. Likewise, you can't pay yourself. In a normal circumstance, if everything is equal, if you're happy, you pay yourself. No. That is it. If you're happy. In terms of knowing. Okay, so this is the treatment. So expect one in the exam. I am done. Now what I'm going to do is very important before I solve the actual question. How to solve concept question in exams, whether P&L or financial position. And console is one of the topics that you can score high there. You can score like, let's say, minimum of 17 out of 20, 22 out of 25, and then 30 out of 35. Yes. Why? This is it. Now I'm going to start the game. So let's set our own question here. Then I'll give 5-minute break for you to articulate all these intra-group, bring all of them together. But the question I'm going to solve, what means is that it will not contain all. Yes, that it does not contain all. Oh, yes. Yes, that I will bring some questions out which contain all everything inside. All the footnotes. So that by the time you finish solving that question. Yeah. Okay, that's just called tutorial.
They don't provide solutions.
Not at all. Okay. Now let's see. So your console question will be like this. They'll start. I'll start with the profit and loss and go to the financial position. Yes. That's right.
They don't mess it up.
Good. Okay, now let's see. Here's a question. You solve it here. So the question will start. Forest group. Forest what? Group. So mahogany. Mahogany. And then odum. So this is the parent, this is the subsidiary. So you prepare profit and loss account here for you. A well-prepared profit and loss account using IAS 27 and IAS 1. IAS 27 talks about separate financial statement. IAS 1 talks about presentation of financial statement. And here the examiner assumes that when it comes to financial preparation, you are superb. So he's aware of that. So that is it. So let's see something here. So the heading must come. Statements of profit or loss for the year ended so and so. So that's the reporting period. Let me make it parent. Subsidiary will be here. Parent and subsidiary. So we start sales. A figure will be there, maybe 40,000. And then here is 25,000. Down up to what? Profit after tax. Up to what? OCI. Through to what? Total comprehensive income for the year. Everything will be given to you like this. When they are done, then we start the footnote. Nice one. Sometimes the footnote will start from the top. We tell you the acquisition details. They come and continue from the down. In solving console question, right after reading the requirements, is that the truth? Right after reading the requirements, you are required to prepare consolidated statement of profit or loss. Please listen to the first word. It says what? Consolidated statement of profit or loss. It didn't say prepare statement of profit and loss. Most students write without the word consolidation. Make it wrong. Good. So you start. Right after the requirement to tell the examiner that the name of the company. Sorry, you can't see from that side there. Hi, trouble. Okay, so P group, the parent group, no more forest, the parent group. So name the parent, this forest group. So P group. Then the requirements, consolidated statement of profit and loss for the year ended, you are done. Your reporting currency may be Ghana cedis in $3. 1, 2, 3. You are done. You write your sales like this. Sales. Open your bracket. Tell the examiner that P plus what S. Don't close it. Leave it. Then go to cost of sales. Normally the cost of sales, go and do workings because a lot of items will be affected. Any item that will affect the profit, something like unrealized profits, intra-group adjustment, PUP, those stuff will affect cost of sales. Sometimes too big. But if the item is too small, you can also open the bracket. But that one stepping down like this. Parent plus a subsidiary. So here, if I want to be practical, parent one is what? 40,000. So you are doing consolidation. Do like this. Plus what? 25,000. Good. This is how I want it. This one means full year consolidation. Check the period of consolidation. For P&L, if I have acquired the subsidiary for 6 months, you have to take only 6 months of what? The item. The subsidiary item. If it's a full year, take the entire amount. So this one means full year consolidation. If it's 6 months, I'll take 6 out of 12 and multiply by 8. And listen, don't close the bracket here because I just copied. So within some few minutes, you copy from sales up to what you see there. Now, when you finish this, then there are some items that most of them don't do it at all. I'll take my time and then do it when I pick P&L first. Good. So you copy everything you see. So cost of sales, parent plus subsidiary. You put it there. You leave it empty. Don't close the bracket because there will be some adjustment. Go to gross profit. Now you can't say parent plus subsidiary, but that one, the answer will come from where? The answer that you get here. Then move on to the next one. Maybe they'll tell you admin. That one to parent plus the subsidiary. So you do all for what you see. Copy the format. Don't check the format though. The format that you see in the exams, how they have arranged it. Copy the same format and open the bracket and put it there. That's the tone for the examination. Financial position do the same thing. We'll do it. And when you're done with that, you now go and read the footnote and start your work. You are done. Please don't start any calculation. You have not gone through all the footnote. Good. So basically, that is it. When you go to the financial position, do the same thing. Financial position, goodwill and associates. When there's associates in the question, when there's a good in the question, kindly create rooms for them. So I'll do that one also. So you record it. Those that will be affected after the footnote come and then affect them. Even if you cannot tackle anything in the footnote, you copying from this up to the profit of the tax for us will score you marks. I think around 5 now to get. Yes, because this one is for you, this one is for you, this one is for you, this one is for you. These are not markets. This one for this one for this one for you. By the time you finish, from the face alone, you score everything there. Just count the items that you see in the face. At least you score most of them correct there. Before you go and read the footnote, those that might be adjusted. You start, okay, this one I'll add to the cost of sales, and then I'll subtract from what the event is the cost of sales on that item. Or if I'll add the cost of sales, go to the event, go and subtract it there. Then that's all. If you finish all the footnotes, all the adjustments, you close your bracket. Now you are now providing the finances there. Then you are done. That's the end of consolidation. If you don't close it, that means you lose the marks over here, right? Or you want to put something there. But I'm going to penalize you. You can leave it there. Yeah.
Everyone is not allowed to do the working.
Good. What is not allowed is you're not allowed to tell us that sales, the right parents, you are doing consolidation, something like this. Everything must be line. So do what you call line by line consolidation. Must be a line item. In reality, it's not acceptable, but for examination purpose, because of time. Cannot be doing working for all of the items. No, some of them shoot on the face and move on. So what we don't want to see is this, right here sales. And just have like parents. Someone put 40,000 here. You come down, substitute. You put what? 25,000 here. But you're even showing it here. 40,000, 25,000. Tell us that adjustment. Maybe you subtracting 5,000 from there. Then you say, okay, the final answer is 60,000. What are you doing? Don't you see something like this? No. Don't you see something like this? If you say sales, if you mention sales, it must be one line item. If you mention sales like this, open your bracket, parent on plus substitute. If there's any intra-group adjustment, let's say, finance put it there, we are done. If there's 6 month acquisition, take 6 months out of what 12 months, and then you are done. Okay. Great. So basically, that is it. That is how the consolidation be. But check the period of consolidation. If it's 3 months, take 3 months. If it's 6 months, take 6 months. If it's 8 months, take 8 months. So read the acquisition period, and check the reporting period. How do you get a reporting period? Go to the financial position, or go to the requirement, it will be there. Or go to the financial that they've given you, the reporting date will be stated on top of it. That is it. That's the reporting period. And then check the acquisition. Normally, the acquisition will come from the first paragraph on top of the financials. We are done. Good. So that's the end of consolidation. Now let's go to the financial position. Let me talk something about financial position. This P&L. And then P&L, there's some adjustments there. I'll do it when I pick a full question on Saturday, where you have to share the total profit to both equity holders of what? The owner and what? The NCI, right? Good. So we have to share that one. That one, most people don't do it, but please, not you. You are going to do it for me. So Saturday, we'll look at that one too, how to share that one. But you can pick any questions, not exactly when I come in, come along with it, and we share it together, then we're fine. Good. Now let's look at how the structure of the financial position look like. But the one I want to be. Great. The structure still parent group, P group must be here. Console must come first, but don't see console. So consolidated statement of financial position as a order continue. Reporting currency, the results, don't forget it. Now, here, everything that you see, we copy it from the page. So that what is that? To avoid trouble, check for 2 items. Do you have associate in a question? If yes, then create 2 columns on them. So start with goodwill. Always start with goodwill. Leave it empty. But if you don't start with goodwill, you leave the items there. You won't create space for goodwill. When you finish, you calculate it, but I don't know where to place it and come trouble. So start with goodwill so that it will be part of you. That even after I go and calculate goodwill, I've created space for it so that I come and put it there. If there's associate in the question, we say investment in what? Associate. We don't consolidate associate. We don't do what? Consolidate associate. Why? We said that we don't have what? Control. We only have what? Significant influence. So we have what we call investment. It's an investment. So we write investment in associate. Investment in what? Associate. Or you can name the person. If the person is star, if the star acquire moon and acquire 20% of what? Star. So investment in what? Star. But you can just put associate there. Don't want trouble. You can just put associate there. Investment in associate. Then you are done. Put the figure here. We've gone through how to get this figure, right? Look at the format. Then the next item, sometimes the very first item will be PP. So open PP like this, open a bracket. Parent owned plus subsidiaries owned. Please, for the financial position, we don't prorate it. We don't say, okay, we acquired a subsidiary for 6 months. We are taking 6 months of the PP. Not at all, don't prorate it. Yes. Why? Because the financial position is cumulative. Here and there is what? For a year, particular period, for a year. So that one you can prorate it. Good. So don't prorate financial position. Except for the retained earnings side. Something that have to do with what? Profit. Something that have to do with what? Profit. That one you can prorate it because profit items we attributed to the period that must be prorate. And we have to prorate it. Then you move on. Then you go to investment. Bring it. Investment. If the right investment, bring it. If the right investment is subsidy, we don't bring it. We don't consolidate what investment is subsidy. That's what we used to calculate what the goodwill.
What is the right investment that you have?
If the right, if we see only investment, please bring it.
What is the thing bigger than the
In fact, bring it. If you see the word investment, bring it. If you see the word investment,
okay, Fred.
bring it like this. Write it here. Don't come and put it here. Maybe it was 20,000. Bring it here. Then go and calculate your cost of investment. If you get 20,000, come and subtract it from it. You are done. That's all. Because they didn't state it. They didn't state whether it's investment or subsidy or other investments. If you go and calculate it and have list 18,000, the cost of investment is 18,000. Come and write 18,000 like this. That means the parent was having other investment. So it will be what? 2,000. So if you see the word investment, bring it. But as soon as they say investment in a subsidy, don't touch it. If you see investment and even is equal to the cost of control, still bring it and subtract and get 0 and get 2 ticks for yourself. How we get it? But if they mention investment in subsidy, if you bring it, you mind. If I have investment in subsidy here like this, I come and do 20,000 minus 20, I will not mind. Yes, I say investment subsidy, don't consider investment subsidy. But if I say investment, it can happen that the parent is having other investments other than the one that invested in the subsidy. Good. So that is it. Okay, so now let's continue the game. So I'm now the investment. The same way there's Intra group loan that we are affected. The investment brings only for the parent. If the subsidies owned, you can also bring it, but less what cost of control. Then bring it the less cost of control. Any other assets, you are done. You put all together. You leave a space. At least look 2 lines, 1, 2. But I don't know what will happen. Sometimes the footnote will create additional non-current assets. Yes. They were told that the subsidiary, at the time of acquisition, the subsidiary have intangible assets, such as what? Patent or brand name. But the subsidiary have not recorded it. But it have active market and there's fair value for it. What do you do? I'm going to record it. So you create additional non-current assets. So leave like 2 lines before you come and put a total here. All of this you've not tackled the footnote. I'm not tackling it in the footnote. Put it here. You go to your current assets, the same thing. If you go to your current assets, so let me do the current assets on top so that I can get enough space. I'm done with the non-current assets. I'll do it section by section. When you go to your current assets, all what you see there, open a bracket, inventory. Sometimes the examiner will put everything together. That's if the question is both P&L and balance sheet, we'll put all current assets together. Good. But if they have separated you to do the separation, solution to every question is the question itself. So inventory, parent owned plus what? Subsidiary. Leave it. If there's goods in transit, all those ones. The unrealized profits, they are just it. You go to receivable, the same thing, parent plus subsidiary. You go to cash, parent plus what? Subsidiary, like this. Yeah. Don't close the bracket because it's not after the footnotes. If you go, those that you can do, bring them. If you can't do anything, leave it. They're done. Yes. Then here too, you leave one line. Write the total here. That's all for current assets. The next line, write the total assets. You are done. How they have added it. If they move, you move. If they stop, you stop. You go by their section. So from current assets, what is their next stop? You also go there. That's all. So follow the format over there, and then you are done. The format that you see there, follow the same format. Don't change the format over there. It's a well-prepared financial statement using IAS 27 and IAS 1. You don't need to change it. Just copy and paste, put it there, you are done. Okay, that is it. I'm down the current asset. You add or you get the total assets. Let me go to the equity section. Then you're moving on to equity. Equity. When you go to equity, we don't consolidate the equity items for the subsidiary. Only parents, especially the stated capital, right? Stated capital, only parents. The equity shares, you will not consolidate that of what? The subsidiary. Why? That is what we used to calculate what? The net asset transfer to calculate what? The goodwill. So it's inside the goodwill. So do not add it again. Double counting. So stated capital in bracket only parents at reporting, put it there. Don't forget that if there was share for share in a question or share exchange, open a bracket, the one at the reporting parent own plus what? The share exchange. And got it there, you are done. Check all these things. Have it share exchange, and then you are done. Basically, that's how I want to do the consolidation. Then, right from here, you go to your group retained earnings, and you know how to calculate it. Examiner knows that when it comes to that session, you are very good at it. So, group what? Retained earnings. So, group retained earnings. Working number 5 or so. Right after the group retained earnings, what do you do? Group retained earnings. Then, if there's any other reserves, here the other reserves, sometimes you can add it to the group retained earnings calculation to pick the examiner. But in a genuine case or professional treatment, it might be on its own. That's the reserves, other reserves. So, other reserves. Other reserves. So you put all of them. Other reserves, all this on parent own, and then you add the parent share from the subsidiary. Then you put it together. You are done. You put all together, that's the total equity. Then come and write what you call NCI at reporting, non-controlling interest, NCI. So that's the NCI, their value. NCI value at what? At reporting. Come on, body there. This working some assets, so I won't talk about it. Done. Then you got a total equity, right? Total. Okay. Then you go to the non-current liability. Non-current what? Liability. Then current liability. You consolidate, you are there. That's all. You consolidate, then you are there. Okay, so that's the end of consolidation fully. So now you've treated consolidation fully. And you can pick a question. I'll pick a very first question to try it. Another question is a bit technical. What can we do? It cannot contain all the footnotes that I want to, but what can we do? We can look at this very well. Okay, so this is the question. We can take picture of it. Good. Now let's solve question called PI. PI. That's the question. So now let's look at this question. This question. 28 PI. Go straight to the requirement. Straight to the requirement and know that it's console. But it can also be ratio. Yes. Be sure that it's a console question I want to solve. Okay. Prepare consolidated statement of financial position for PI as at what? 31st March 2011. Now, as soon as you read the requirement, please write the reporting year boldly on the question paper. The reporting year, so that it will guide you. Where does this reporting year start from? 31st March. It ends at 31st March 2011. So start from where? 1st April 2010. Good. So 1st April 2010. So any day they could, I just have to match it. Okay. Now let's see. So from there, you start the footnote. For console, the footnote start from the very first aspect. That's what the footnote start from. So let's start the game. Let's start the game. Let's start the game. Okay. Let's start the game. Okay. So start like this. On April 1st, 2010. Wow, exactly 1 year, right? So full year. Wow. PI acquired 75% of SR's 8 million equity shares in a share exchange of 3 shares in PI for every 2 shares in SR. Okay. The market prices of the PIs and SR's shares at the date of acquisition were 3.2 and 4.5. Here, please, we are interested in the share price of what? The parent, because the parent are giving out the shares. So what you do is you find the number of shares acquired times the ratio, then times the price. So 75% of 8 million will give out the total number of shares acquired. Now times the ratio, the share exchange ratio, 3 shares, so 3 will be on top. So 3 shares in PI for every 2 shares in SR. So to be 3/2, right? Good. So not always the small one on top. For those of you who have target like always the small ones must be on top. Here they have what? Swerve you. Nicely like that. Okay. Now the share price of the subsidiary SR, it means that when it's in the question, it means that the NCR will be at full goodwill and will not give you the fair value of the NCR. You have to use the share price. And they will tell you, a good examiner will tell you. A good examiner will tell you. Good. That doesn't mean that if they don't tell you, they are bad examiners. In addition to this, PI agreed to pay a further amount on 1st April 2011. 1st April 2011. That will be when? Exactly 1 year later, right? Good. That was contingent upon the post-acquisition performance of SR. I like it. This one is what? Contingent what? Consideration. I like that. Of SR. At the date of acquisition, PI assessed the fair value of this contingent consideration at what? 4.2 million. But by 31st March 2011, it was clear that the actual amount to be paid will be only 2.7 million. Ignore discounting. I like that. The 2.7 million is the fair value of the contingent consideration at the end of what? Reporting. Because as of 31st March 2001, that's the end of the reporting period. Agreed. So we said that with the contingent consideration, first, record the one at acquisition, the fair value at acquisition, record it in the cost of control. When you are done, relax. In the reporting period, compare the fair value at the acquisition and fair value at reporting. If there's any changes, it must enter where the parent will book retained earnings. You are done. Gain or loss. So when you go there, you realize that the fair value has decreased, right? So is it a loss to the parent or the gain to the parent? It was a gain to the parent because he is going to pay 4.2 million and now it has dropped to 2.7. It's not a gain to you. You promised the guy that I'll give you, in addition to what the shares I've given you, I'll give you extra 4.2 if your performance is good. But I don't the reporting period. When I says, I only pay 2.7 million, that's super odd, fantastic. Great. So here, all what you have to do is, when you're calculating your cost of control, add 4.2 million there, add a 4.2 million, and you check whether it has been recorded. Whether this has been recorded. Let's read further. PI, the parent, has recorded the share exchange and has provided for the initial estimate of the 4.2 for the contingent consideration. Wow, he has to make a provision for what? The initial, not the one at reporting. In some extreme case, they'll tell that nothing has been recorded for the contingent. You have to do everything. It's a provision, but it must be part of what? The non-current liabilities. So let's go and see whether it's there. Is there contingent consideration? The parent has recorded 4.2 million. If they don't record, they record it as they've done it here. As they've done it here. They have showed it as what? Current liability because it deemed to be paid 1 year, right? Within one financial year. So that's the current liability. If you go beyond one financial year, non-current liability. Good, you have to record it. Now let's continue again. I like this question though. You find the difference between 4.2 million and 2.7, which is a gain to the parents because what you're going to pay has dropped. So the gain will go to the group retained earnings. You add the difference. And then when you go to when you're doing the consolidation, there are 4.2 million. You have to perform a magic and you change it to 2.7. So the difference, the gain, come and subtract it from the 4.2 million and record it there as well, contingent consideration. As it is, you are done. Let's continue the game. Okay. Now, first, add a 4.2 to that of the cost of control. Good. Second, find the difference between the 4.2 and 2.7. Add the group return and go and subtract it from the provision made in the financial statement. So that at the end of the day, the provision was 2.7, not the 4.2. That's all. Yeah, done. Now let's move on to the next statement. On October 1st, 2010, PI, October 1st, 2010. So from October 1st, 2010 up to 31st March 2001 or 2011. How many months? We calculate 6 months, right? Okay, so 3 months to the year and 3 months to March. So 6 months. Great. On October 1st, 2010, PI also acquired 40% of the 5 million equity shares of AD, paying 4 million in what? In cash per acquired share. 4 million. Sorry, it's 4 Ghana cedis in cash per share. So that is, let me take it again. On October 1st, 2010, PI also acquired 40% of the 5 million equity shares of AD, paying 4 Ghana cedis in cash per acquired share and issuing at par 100 Ghana cedis 7% loan note for every 50 Ghana cedis, so every 50 shares acquired in AD. This consideration has also been recorded by P. P has no other investment. Good. So here, PI has given loan to that of what? Here, associate, not what? Subsidiary. Investor have given loan to what? The investee. Good. So how do you record it? Here, the dividend or the interest must be emulated when you check if it has been paid. Good. Now, the associate is not part of the group. Associate is not part of what? The group. Yes, associate is an outsider. That's the name group. It's an outsider. So we don't normally emulate the intra group from the associate. Yes. Sales between parent and then the associate must not be emulated except for the unrealized profit section. So the same thing apply here. But the dividend will be eliminated. Interest will be eliminated. Good. Now let's see. Yes, please. Exactly. Now let's see. The summarized statement of financial position of the three companies at 31st March 2001 are as follows. So all of them are there. So you can see clearly non-current assets, they are there. PPE, all of them are there. Investment, you see here they wrote what? Investment. So I'll bring it, Papa. Because they say investment. They didn't tell me investment in SR or AD. So I'll bring it and then balance it. Subtract all what you paid for that of SR and AD. If they are not equal to the 45, the difference represents what? Other investment. I'll put it there. We are done. Okay. Then current assets. Inventory. All of them are there. So all of them are there. Now let's go straight to the footnote then. That's for the okay. Let me do the slides more together. So note 1, it says that at the date of acquisition, the fair values of SR property, plant, and equipment was equal to their carrying amount, with the exception of SR's factory, which had a fair value of 2 million above its carrying amount. That's fair value of adjustment. SR has not adjusted the carrying amount of the factory as a result of the fair value exercise. Great. So what do? You go to at acquisition, you put 2 million there. At reporting, put 2 million there. Post dash, we're done. And please, whatever you place at reporting must enter the financial position. Period. So after putting it at reporting, come to the face where you wrote parent PPE 37,500 plus the subsidiaries own plus what? 2 million. We're done. That note is clear. That have any issue with you. Let's continue with the note. Now, this required additional annual depreciation because we say what? Fair value adjustment, if it's upward, it's going to call what? Additional depreciation. And the examiner is very good one. He has calculated it for you to be what? 100,000. But in some cases, you have to calculate it yourself. It's equal to the gain over what? The remaining useful life from the date of acquisition times the period of consolidation. Don't forget. Times what? Period of consolidation. If it's 6 months, take 6 months out of what? 12 months, and then you are done. So this 100, how do you treat the 100? The additional depreciation. First, who is using the asset? The subsidiary, right? Its profit must go down by 100. So go to net assets at reporting and write additional depreciation, 100, put in brackets. Put the same figure at what? Post-acquisition, you are subtracting depreciation. The same figure will go to what? Post-acquisition bracket. And we said that whatever enters the reporting goes where? Goes to a financial position. So go to the financial position. The same PPE again, go and subtract 100 from there. So parents own plus subsidiaries own plus the 2 million less what? 100,000. You are done. That note is fully cleared. Now let's move on. Also, at the date of acquisition, SL had an intangible asset of 500,000 for software in its statement of financial position. PI's directors believed the software to have no recoverable value at the date of acquisition, and SL wrote it off shortly after its acquisition. Good. Let's take it again. Also, at the date of acquisition, SL had what? An intangible asset of what? 500,000 for software in its statement of what? Financial position. So intangible asset. Intangible assets of 500,000, which has been what? Written off. Good. Now, the PI's directors believe the software to have no what? Recoverable value at the date of what? Acquisition. And SR wrote it off shortly after its acquisition. That means they have included certain things which supposed not be part of what? The net asset. They said it has been what? Included. So it has been included. So the net asset includes. So that means that equity that we see there, it is part of the that this 500,000 has been included in the net asset at acquisition. So you have to what? Take it off from acquisition. As reporting, you put dash there. Why? Because it has been written off. So it will not be reflected there. So we have to take it off from where? From acquisition. How we get it? That's all. Only acquisition. But they've taken it off. They've taken it off after the acquisition. So the reporting figure does not include that 500,000, and that's good. But does not have any recoverable amount. Now let's see. So that's the end of the note 1. Let's go to note 2. At 31st March 2001, so 2011, PI's current account with SR was 3.4 million debit. I like that. Debit means receivable, right? Or receivable. Debit means receivable, right? Okay. Receivable and payable, which of them have debit balance? Receivable. So debit means receivable. That is it. So parent, in parent books, parents say that, okay, substitute, you are owing me, you're owing me what? 3.4 million. So it's part of my receivable. Yet to receive from who? You. We said that the current account takes care of what? Owings between what? The group members, parents and what? Substitute, and vice versa. Good. This did not agree with the equivalent balance in what? The subsidiaries books due to some goods in what? In transit. Invoice at what? 1.8 million. This is what? Goods in what? Transit. So go to the note. What you said we should treat it. That were sent by the parent on 28th March. That's 3 days to the year end. How on earth will the goods arrive? 3 days to the year end. Let us know these members. They are in different countries. They are not in the same country. One is in South Africa and one is in Ghana. Parent is in Ghana, subsidiary in South Africa. Or parent in South Africa, subsidiary in what? Is in Ghana. So 3 days, the goods will not reach the subsidiary. So subsidiary 2, if there's no evidence, I'm not going to record it too. No goods, parent, no goods, no recording. Now let's see. But had not been received by ESA until after the year end. PI sold all these goods at cost plus what? 50%. So cost plus what? 50%. Good. cost plus 50%. So there'll be PUP, right? PUP on the goods. So 1.8 million, you calculate what? The profit loading on what? 1.8 million. And you take it off, right? But this one, who can tell me the goods left in inventory? Because we said that the PUP, it must be on what? The goods left in inventory. If the subsidiary is able to pass on the goods, there's no PUP. In fact, here the entire goods is in inventory. Because the guy have not even received it until the year end. The guy have not received it after the year end, right? So in fact, all the goods are there. They have not even passed it on. So all the goods, the entire 1.8 million, they are there. So find the profit loading on the 1.8 million. This one is what? Cost plus. So that's markup. So you got it up, right? 50 over 150 times 1.8. Whatever you get, that's our highest profit. What is the accounting treatment? The seller's profit. Who is the seller? The parent. Group retained earnings. Subtract from there. Go to the group inventory. Subtract from the group inventory. You are done. Then come and deal with what? The 1.8 million, the goods in transit. How do you treat this? We said that goods in transit first. Assume that the receiving company have what? Receive it. So the subsidiary have received it, right? What will happen to the subsidiaries? If I receive the money, so if I receive the goods 1.8, so first the 1.8 million, the treatment when the subsidiary receive the goods, what will be the accounting treatment? One, it increase is payable, right? So add it to the payable. To add 1.8 million to what? Payable. Second, what happens to the goods? Inventory will increase. Add the group inventory. You are done. When you are done, eliminate the both. Eliminate what? The total. Eliminate the total. And then you are done. Eliminate the total of 3.4. So subtract 3.4 from payable, 3.4 from receivable. Good. Receivable and payable. Good. Then you add 1.8 to the inventory. And done with the deal. That's all. That's all for good. That's more. It's so simple, right? But recording it some way. Now let's move on. Note 3. PI's policy is to value the non-controlling interest at fair value at the date of what? Acquisition. For this purpose, SR share price at the date of acquisition or at that date can be deemed to be the representative of the fair value of the shares held by the NCI. So like I told you, anytime you see the share price of the subsidiary, that won't give you the NCI's fair value at acquisition, won't give it to you. So how do you get it? Go and calculate the number of shares held by the NCI. So let's go up here. If parents acquire 75, NCI will be what? 25. So 25 of the 8 million shares. That's the number of shares held by what? The NCI, the guys. Then what do? Then you multiply it by the subsidiary share price, which is what? 4.5. That's the fair value of NCI at reporting. And then you are done. Beautiful like that. Then you are going to use that one to calculate your goodwill. Then the NCI to reporting, and then you are done. Good. That is it. Okay, now let's move on with the game. I like this question. Note 4. Impairment tests. Impairment tests were carried on 31st March 2011, which concluded that the value of the investment in the AD, that's the associate, was not impaired, but due to poor trading performance, consolidated goodwill was impaired by 3.8 million. So what do? Impairment, 3.8 million. After you get a goodwill at acquisition, less impairment, 3.8 million from it, you get what? Goodwill at reporting. Then you go and share this impairment loss to who? Group retained earnings, that's the parent share, and the NCI share in NCI reporting. You are done. Because the goodwill is at what? Fair value or full goodwill. Now let's see this. The last footnote. The last footnote says that assume all profits accrue evenly throughout the year. When you see note like this, it tells you that there's mid-year acquisition. So it tells you that one of the either the subsidiary or the associate was acquired mid-year, or all of them were acquired mid-year. And clearly the associate was acquired 6 months to the year end, right? Good. So that's what the mid-year. That's all. That's the mid-year. Great. So now after reading all this, the next item is stats. You just copy these formats. You copy the formats. You copy everything. Don't forget the 2 items. Don't forget the 2 items I mentioned. Goodwill and investment in who? Associate. If there's associate in the question. Write it. First thing, the first item you have to do, you write the goodwill, investment associate. Then you go to PPE. Write the PPE, parent plus subsidiary. You go to investment, parent plus who? Subsidiary. Wait. You leave, let's say, 2 spaces. Then you move on to the next item. Great. 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 So let's start the game. Let's market the board. So I'm assuming that this is your answer booklet. Your answer booklet. So if this is your answer booklet, all you have to do is I'll go up a little and write the name of what? The company, the requirement, the 3 protocols. So let's go straight to the requirement. So we should calculate what? It's for PI. PI limited. So just tell the examiner that PI group. Good. I'll start consolidated. I hope we should go here. Okay. P group is not coming. Good. So P group consolidated statement of financial position as at 31st March 2000X1. I'm done. Currency was in millions or thousands. I guess it was in thousands. Let's go. Our friends online, you can see the writing. So the figures are in thousands of cities. So right here, Ghana cities in thousands. Nicely like. Don't forget, once there's associate in a person, do not forget this. Start with your goodwill. Leave a space for it. Investment in associate. Investment in what? Associate. Also leave a space for it, right? Then go to the face of the financial position. Go there. Then tell yourself parent plus what? The subsidiary. So parent own is what? You start from the non-current asset. But you're supposed to write non-current asset on top to avoid trouble. When you move, you move. So here must be non-current asset. The assets that they put there, you can ignore. Okay. So you write PP, no calculate to PP. Here, my own is no go here. So I'll come down like this. Open a bracket, parent owned plus subsidies owned. Parent owned plus what? The subsidies owned. What's the parent's figure? 37,500 to 37,500 plus subsidy 24,500. I'll leave it there. If I've gone through the notes already, those adjustments, you can just bring them here. Can I go ahead? Good. Set up plus 2,000 minus 100, right? Good. Then you are done. Now let's see. The next one is investment. They said investment, right? So I write investment. Investment 2, there's 45,000 there. All right, investment. Investment, open a bracket. I'll put the 45,000 here. I'll leave it. Then I will leave it. I will leave it. Good. Okay. Then what I'll do is I'll move on to the next item on the list. When they move, I move. When they stop, I stop. Oh, they are done with the non-current asset. Me too, I'm done. For emergency purposes, I'll leave 2 lines. Emergency purposes, I'll leave 2 lines. So here, this is the total non-current assets. I am done. In that order. Okay. Now over here, when we go through the notes, I want to do everything so that by the time we finish, at least we've done something. We said that we are going to add a 2,000 as we explained in the footnotes. That's the intra-group adjustment. We less what that of the 100 from it. Then we are done. Then we are done. Then what we do is we move on with the game. They went to current asset. They have what? Inventory and trade receivable. No what? No cash. So I'll go there and record inventory and trade receivable. And have you seen that there's no total? They put a total here. They wrote here current assets. So current assets like this. Inventory. I'll open a bracket, parent owned, which is what? Parent owned plus the subsidiary. Parent owned is what? 10,000, subsidiary owned is 9,000, so 10 plus 9. So 10,000 plus 9,000. And then you calculate your PUP. It's not calculated, so I'll leave it like that. And then goods in transit 1.8 million, you add, right? Perfect. Let me add the goods in transit. You add the inventory 1.8 million, so that will be 1,800. Good. Have you seen any time to not go there, right? You have to step him down. So I'll do it here. If I do it here, plenty things not go there. You are feeling. Let's go to trade receivable. Trade receivable 2. Down. No, you have to do this one first. Go and do the workings. What you do, you can do it. The note are like they are come. This one, they are 3 marks that you can score. You go to trade receivable 6,500 plus 1,005. So 6,500 plus the 1,005. Have you seen enough? Make it open, right? Only the PP, because PP, I'm sure that I'm done. If I'm not done, I'll have to leave it open until the final workings, then close it. Let's move on. So we are done. We go to equity, right? Equity is after the capital and the income surplus. So very good. When you go to equity, so let me do the equity here. I'll continue write equity here. Equity, when I pick stated capital, only parents. So say stated capital, only parents. Let's come down small. Stated capital, only parents. So stated capital. Don't forget the parent owned, there was share for share exchange, which have not been recorded. So open your bracket, go and calculate the share for share exchange and come and add it. What's the stated capital for the parent? Stated capital for the parent is 44,800. Here you don't add the subsidies own. So 44,800. If you finish with the out of the share exchange, come and add it to it. You put it there, you are done. You go to group retained earnings and NCI. So group retained earnings, that's your workings. NCI at report non-controlling interest. You bring all of these three people here, then you are done. So that's the end of what? The equity session. So you are done with the equity. What you are adding is group retained earnings and then that of the NCI here, the NCI at reporting. Then we are done. Then we are done. Basically, then we are done. Basically, okay. Now let's continue the game. So from equity, quickly go to non-current liability as they've done there. 7% loan note. Open a bracket. 14,000 plus 2,000. I'll do that one at the other side of the board. The income surplus, no. From the stated capital, go to group retained earnings and the NCI, you are done. Good. So you come here, then you record non-current liability. I want to put that at the top so that I can get enough space to do my reference. Non-current liability. How that side is coming. Let me do something about this. So non-current liability, no shortcuts. They wrote 7% loan note, right? Open a bracket. Parent owned plus what? Subsidiary. Don't forget the game. Parent owned plus subsidiary. No associate. So let's go and pick the parent figure. Parent figure is, I think, 14,500 or so. Plus 2,000. 14,500 plus 2,000. So 14,500 plus 2,000. Leave it empty. Then move on to the next one, contingent consideration. The next one is what? Current liabilities. There's demarcation, right? So current liabilities, contingent consideration, and other liabilities. So let's go. Current liabilities. So CL. They wrote contingent liabilities. So with the contingent liabilities, the open, that's the contingent consideration, right? You open your bracket, it's 4,200, right? Then we subtract the gain, right? From it, you get a 2,007. You can, if I read a footnote, you can just put it as straightforward. You are done. The next one is other liabilities. So other current liabilities. So what they say, what about that figure 2? Other current liabilities, 8,003 and 75. 8,003 and 75. So other current liabilities. Other current liabilities. So let me do that one down. 8,300 plus 7,500. Then when you're done like this, leave it. Move on to the next page. Go and do your workings there. So wherever this one ends, that's all. Go and do your workings. Go and start the workings there. If you end here, you stop the work. Don't touch anything in the footnotes. Ideally, you score something, at least 5 out of 20 marks, 20 marks will be yours. You don't touch anything in footnote. And now you are going to touch the footnote. How? So let's see. So I'll do all my workings here. Please, you are only allowed to copy the workings. Just a friend in person. So I give me the figure so that when you finish, I'll give them. So from here to here, I'll be cleaning it. So if I finish working one, I'll clean it, working two, I'll clean that other. But the space will not be enough. I'll be getting. Or when I clean this one, just go in there to part combination. So that is it. Now let's see. Workings. So I'm doing this on working sheets. Workings. Good. Workings number 1A. What is there? Group structure, right? Group structure. As someone said, room structure. That is it. So group structure. Let's quickly grab that one. So the group structure, write the parent name down, PI, right? Write the investments. Subsidiary is SR, right? SR. And then the associate is what? AD. Associate is what? The AD. So SR and what? AD. How we get it? So this is what we have to do. Let's go to the workings so the workings will come clear. Good. So you go to AD. This is the parent company. So write the parent company here, the name of the parent. What's the investment? Parent is having for 75%, right? In SR. What percent in AD? 40, right? That makes him an investor or associate or significant influence. NCI, non-controlling interest, will be what? 25%, giving us 100%, right? We don't have NCI of associate, so dash. Don't worry yourself. We don't have NCI of what? Associate, so don't bring it at all. We are now the book structure. First working, 1. B, what's the date of acquisition? 1st April, so jot it down. Date of acquisition. So write here date of acquisition on top. Date of what? Acquisition. Date of acquisition. And line it. Just write 1st April. 1st April 2010. But you wrote it X there. You are done. Now B, period of consolidation. Full year. So right, period of consolidation is what? Full year. So that's the C. So working number C, period of consolidation, right? Full year. Oh, now you can copy this section. Give some 3 seconds. I'll take it off. I'll do reference number 2. Great. Okay. Great. Great. Now let's continue with the workings. Workings number 2. What is there? Cost of control. So let's quickly look at the cost of control. So cost of control. So workings 2. Cost of control. Cost of control. Cost of control. Let's look at the cost of control here. Cost of control. First, let's look at the share for share. Share for share. Let's look at the share for share. Here, no cash. After reading, let's go through again. Yes, double reading will not. So on top, wow, they said that On 1st April 2010, PI acquired 75% of SR's 8 million equity shares in share exchange of 3 shares in PI for every 2 shares held in SR. So the market price of PI and SI was there. In addition, PI agreed, so there was no cash. So first, we go to share exchange. So share exchange, tell the examiner that the cost of control start from where? Share exchange. So share exchange. Don't forget your currency in 3 zeros. 3 zeros. Open your bracket nicely. Parent acquired 75% of what? 8 million equity shares. So 8 million, that would be 8,000, right? So this is the number of shares acquired by the what? The ratio 3/2 times the share price of what? The parent. Let's go and pick the share price of the parent quickly. 3.2. Good. So the share price is 3.2. So times Ghana city of what? 3.2. That will give us perfect. So 28,800. Comma. Then you add what you call the contingent consideration. So contingent consideration. So we add a fair value at the date of acquisition, which is what? 4,200. So this is the total cost of what? Control. What's the total cost of what? Control. That's the total cost of control. 33,000. We are done. Okay, so let's move on to workings number 3. Workings number 3. Workings number 3. Workings number 3. Good. Workings number 3. Workings number 3. Workings number 3. Can we continue the game? Workings number 3. So net asset at acquisition, right? And at reporting. Let's go to the net assets as a workings number 3. Workings number 3. Workings number 3. So workings number 3. Workings number 3. Which one? Workings number 3. Press all right. Let's go. No. 33 go to no, 33 will not be anywhere. We are going to less it from the investments. So let's take it off minus 33,000. So level 11, right? 11,000 we will look at where it will. Yes. Now let's move on. Brackets number 3, net assets of the subsidiary. So write net assets of the subsidiary. So net assets of who? The staff. So you can write SR. SR is a subsidiary, right? Okay. SR is a subsidiary. SR is the subsidiary. Okay. If SR is the subsidiary, then we have what you call at what? Acquisition, at what? Reporting, and what? Post acquisition. Post acquisition. Don't forget your currency. 3 zeros. Your currency, don't forget it. Other than that, I'll put mangoes there. are reporting what minus. Good. Net asset of the subsidiary. Now the net asset, go and pick the figures from that of as reporting you can get from the financial position. At acquisition, you have to tell us the retained earnings at the start of the year. Okay, they didn't give it to us. The retained earnings at the start of the year. Or you can get it from the question. So go to the equity section. Have you seen stated capital? The subsidiary one is what? 8,000, right? Good. So build the 8,000. Subsidiary one is what? 8,000. So that is stated capital 8,000. So let's go. Stated capital 8,000. So right 8,000 stated capital. Both at acquisition and at reporting. Why? We assume that there has not been what? Any issue of shares. So you're supposed to be dash. Go again. We'll move the retained earnings. Move the retained earnings. If you move the retained earnings, that's the income surplus. They call it income surplus. As at the 1st April 2010. So the income surplus was 16,000 what? 500. So that's the at what? Acquisition. Here it's coincident that the at acquisition and the open balance are the same because they are of the same date. Let's check up. Because the acquisition date was what? 1st April 2010. Good. But the open balance too is the same as 1st April. So that's what at acquisition 16,500. So income stop loss. I record here income and stop loss 16,500. What about the at reporting? At reporting will be 17,500, everything together, right? And post acquisition will be 1,000. Right. So let's go. Now be with me. 17,500. The post acquisition will be what? 1,000. 1,000 like this. How do you get a post? The post is nothing by at reporting plus at acquisition. You put the answer there. Agree. Okay. Now let's continue the game. The game is getting worse. See. Now with this, then you start with your fair value adjustment. Fair value what? Adjustment. So let's go to the footnote. At the date of acquisition, the fair values of the SR's property, plant, and equipment was equal to their current value, with the exception of SR's what? Factory, which had a fair value of 2 million above its current value. So 2 million, both at acquisition and at reporting, because SR has not adjusted the current values, then that's all. So what you do is you come here. So 2 million, you write a fair value adjustment. So fair value adjustment. So write here factory. Call the name of factory. 2 million. So that'll be 2,000. 2,000 positive. No cash. Agreed. Okay, now let's continue the game. Then the additional depreciation of what? 100, right? Good. So additional, we said that any item that you are going to record it as reporting, which is not here, which is not the financial position, you come and record it. So that's the 2,000 that we recorded here. So this 2,000, after bringing it here, assuming that here was dash, nothing will come here. Nothing much. So nothing was recorded here. If you put something here, please go and find somewhere on the face of the financial position and put it there. So you come and put what you call additional depreciation. Just call it depreciation. You know, every time call depreciation, you understand. Dash and put 100 here. Put in bracket, we are subtracting depreciation. Must be subtracted. Let's look at the workings very well. Okay, so post will be what? 100 to be in brackets. Perfect. Now let's continue the game. Let's continue the game. Then they say again, also at the date of the acquisition, Esther had an intangible asset of 500,000 for software in its statement of financial position. PR directors believe that the software has no recoverable amount, so it must be written off. No recoverable amount, so it must be what? Written off. Just that they did that after the year, after the acquisition, not before the acquisition. So at the date of acquisition, good. Esther wrote it off shortly after the year end. How we get it? Good. So what you do is we have to list it from where the net asset at acquisition alone, not at reporting, because they have wrote it off. So it's not part of the asset that's good, because you have to write it off. It will be at the post. So we call it intangible assets. Intangible assets. So here will be 500 in negative as reporting dash. Here must be positive 500. Positive 500 because 0 minus 500. 0 minus 500. Here is dash. 0 minus 500. Giving us what? Positive 500. Agreed. Perfect. Positive 500. Because we did not place it here at reporting, it not reflect where? Anywhere. To not go where? Anywhere. How we get it? To not go to the financial position because we not place at reporting. Good. To not go there. Okay. That's great. Now let's continue the game. Is there any PUP in which the subsidiary is the seller? The PUP here, the parent was the seller, right? So to not affect, right? Then that's all for the net assets. We are done. That's all for the net assets. We are done. Okay, so let's put all of them together. Get net assets at what? At acquisition. Then I'll quickly do the goodwill, group return earnings, growth. So that is it. Now, with that of the intangible assets, that's the 500. They said that the parent company believed that the intangible assets have no recoverable amount. So anytime a particular asset does not have any recoverable amount, that asset must be written off. That means the carrying value is more than the recoverable amount. And here the recoverable amount is 0. So the entire carrying value must be written off according to IAS 36 impairment. So the carrying value of the software, which is 500, must be written off. The entire 500 must be written off. And here, just that they did that. The subsidiary company wrote it off. They say, and wrote it off shortly after its acquisition. So that means at the date of acquisition, that it was there. At the date of acquisition, it was what? There. It was available. So it was there at the date of acquisition. So that means we have to write it off at that date too. So how do you write it off? We have to, like the same way we treat what? Depreciation. So go to the subsidiary's profit and subtract it. At acquisition, we are looking at acquisition. And here will be dash. At reporting will be dash. Then we bring the movement to that of the post-acquisition section. Great. Okay. The difference is what? It's 1,004. I would disagree.
For the post acquisition.
Great. Okay, so we get something like 26,000, right? So the total will be 26,000. 27,400 and 1,400. Okay, now let's continue the game. The next working is what? This working is number 3. Let's go to working 4. Goodwill, right? Working is number what? 4. Goodwill. So working 4. Goodwill. 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 Then right after working 4, 11. 3 workings, and that's the end game. Working 4. Goodwill. Working 4 is goodwill. Working 4, goodwill. Now the goodwill, we are using the full goodwill method. We are using what? Full goodwill bracket right here, fair value. Fair value method. So that it will remind us. Fair value method. Full goodwill method. The goodwill is what? The goodwill of the parent plus what? The goodwill of what? It's plus the goodwill of NCI. No. No. Two different not together. Subsidiary and NCI are two different things. NCI, this is the subsidiary. SA. SA shares is 8,000. Parent have acquired 7,500, 75%. And some people to have also acquired the remaining percentage, which is what 25. These people are called what? The NCI. So this is a different, right? They bought shares, but their shares are not their owner. They are holders, but they are, how do you call it? Their shares does not amount to control. It's none of the control. So we call it non-controlling interest. Previously, we call it minority. And then we call these people majority. But you know, if you're going to call someone minor, inferior, it's a nice one, right? So that's why we call it non-controlling interest. And it's okay, great. Now, cost of control. We start from cost of control. Cost of what? Control. Cost of control will be, don't forget your treasures, 33,000. Add the fair value of NCI at acquisition. Fair value of what? NCI at acquisition. And here they give us, they didn't give it to us, but they asked us that we should use the number of shares held by the NCI. The entire shares is 8,000. NCI percentage is for 25% of 8,000 times the share price of what? The subsidiary, which is 4.5. The share price is 4.5 Ghana cedis. That's the share price of the subsidiary. And that will give us 9,000. I like that. Put all together. Tell examiner that this is the total consideration transferred. So how much parent paid, that's the cost of consideration. How much the NCI also paid for the 25 shares, putting together the total amount we transferred to acquire the sub. That would be what? 44,000, right? Or 42,000. Then what do? The less the net asset at what? Acquisition. You call this one total consideration. If you don't trouble, don't write it. Don't trouble, don't write it. The less what? The net assets at what? Acquisition. Net asset at what? at acquisition. So what do? Net asset after acquisition, 26,000, right? So leaving an amount of 16,000, right? So that's 16,000. This is what you call goodwill at what? At acquisition. So when I ask you to calculate the goodwill at acquisition, that's the answer. Goodwill at acquisition. Great. Goodwill at acquisition. So let's record it here. This one, others. Video. Total net. So this goodwill at acquisition. Good. What do? Impairment, right? Impairment. What's the impairment? Impairment is 3,800, right? Good. So take off impairment from it. Then you are done. So impairment is 3,800. So what do you get? 12,200. So that is the goodwill at reporting. Call it goodwill at what? Reporting. Perfect. So come and put it here. Goodwill workings. Goodwill was here. Workings number 4. That is what? 12,200. Great. 12,200. Perfect. So unfortunately for us, this is how far the good Lord will bring us. Kindly follow up to the next section to get the full section of the solution. So that is it. Kindly subscribe if I've not done that. And then we'll continue with the workings in a subsequent video. So I'll bring this section. Good. So that is it.